Ladies and gentlemen, good day and welcome to Trustline Advisors LLP investor call for AIF fund. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing the star then 0 on a touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Arunagiri, Founder, CEO and Chief Investment Officer. Thank you and over to you, sir.
Thank you. Good afternoon, everyone. Welcome to our investor call. I'm really happy to be here after 6 months. Last call we had in October 2024. And thank you. Really, all of you have taken time on a weekend to join this call. Appreciate that. This call is important for 2 reasons. One, our fund is already closed. It has reached its maturity and currently we are in liquidation period. So investors would like to understand more about our liquidation plans. And second reason is investors are curious to know our view in terms of where the markets are headed in the current volatile environment. Will that have any impact on our liquidation plans? So these are the broad 2 issues we would like to cover in this call. And after that, I will also briefly touch upon our current fund position and the performance, little bit how it has performed in April, and then throw the floor open for Q&A. That's a broad plan. So let me get it started with the market outlook. So it's understandable that a lot of investors want to hear our, views in terms of concrete views and firm and concrete views in terms of how the market is likely to play out, where the market is headed. And though it is understandable, it's currently, to be honest with you all, it's very difficult to form a very concrete and firm view because of the challenging times we are going through and a very volatile environment. So not only it's challenging, it will also be very foolhardy to have a very firm view in this volatile environment. So what we are going to do is to look at the market through 2 camps of believers, one on the pessimistic side and the other on the optimistic side. Very contrasting, diverging views of these 2 camps and study them through, kind of what probability is likely to play between these 2 scenarios. That's how I would like to look at. That will make us it less challenging in terms of understanding and to make sense out of what markets are likely to do. Before that, just to set the context, let me also, look at U.S. and, global markets volatility, just to give a sense on how deep into what what kind of volatility in the global environment. Let me look at, as an example, S&P 500 and give you some indication and data points in terms of how volatile the markets have been. If you look at S&P 500, currently in this month, from the Liberation Day when the reciprocal tariffs were announced, it's about 3% down. It looks very nominal. That doesn't tell you the full picture. It actually hides more than what it reveals. If you look at the kind of levels it touched, and it has been all over the place in the last 15-20 days. Before the Liberation Day, it was around 5,700. And post this reciprocal tariff announcement, it all the way came down to 5,000. And so 5,700 to 5,000 in just few trading days. That was about 15% drop in a large market index like S&P 500. And when the tariff tantrums played out, it again now has come back to all the way up to 55, 54, 5,500, which means it's up by about 10% from the lows. So that is a level of volatility which we have never witnessed in a market like US we are currently witnessing, right? The other way to look at VIX index, the volatility index, right? It almost peaked at 50, kind of level in this month when the tantrum played out on tariff, right? The last time it had touched such a high level was COVID in March 2020 when it hit 60 level. Now from 50, it is all the way back to about 23, 24, though it is still at an elevated level compared to where it used to be about few weeks back before March at about 16, 15 levels. which means the market is telling you that it is still expecting a lot more volatility in the global markets. That's the current setting. Now, moving back to the two camps of believers, the first camp, they argue and believe that the current tariff policies or regime is likely to escalate and result in a sharp slowdown in investments in U.S., capital investments, business investments, because of uncertainties, also which will lead to a higher inflation rate. As a result, will lead to a very, very sharp slowdown in economic activities, which will lead to a sharp recession. This is one of the pessimistic view. A lot of market participants believe that the dollar index as well as the US yield will, dollar index will probably collapse and the US yield will rise to a very elevated level. And even though in this scenario, India could probably well insulate it because of its very low exposure to exports. It's just about 15% of GDP. And also, we have a lot more friendly bilateral trade arrangement which could probably happen. In spite of that, the collateral damage in India will be much more severe in the first scenario. Though India is far more insulated, it's largely a domestic-driven economy with much less exposure to U.S. exports. The collateral damage will be much more severe for Indian markets, right? This is one scenario. On the other side of the camp, which is more optimistic, positive, is that the believers in this camp argue that the bond markets will be a huge check and balance for all that tantrums and tariff announcements. Even if the Trump administration is unleashing major damage through all these announcements, bond markets will make sure that the damage is limited by its action, which we saw the signs in the reciprocal tariffs. So, the moment the bond U.S. Treasury yield is sharply spiked, the Trump administration blinked and they, rolled back or sort of resorted to 90 days pause on the reciprocal tariffs. And any major deviations in policies will get checked by the bond markets and to some extent dollar index. So they believe that there is a huge check and balance by the bond markets. As a result, I think the policy regime will be much more saner and they will also be much more realistic. So as a result, they believe that it is unlikely that US, though they may slow down from the current level of growth, which is 1.8 to 2%, which might probably drop to about 1.1, 1.2%, but it's very unlikely to hit a recession kind of a red flag. So also, this camp believes that US dollar index probably will be on a declining, softer trend, not sharply going down, but on a trending down kind of an environment with US yields being a little elevated. In this kind of scenario, how would India, play Indian markets? How will it play for Indian markets? That's in their view, I think emerging markets will largely benefit both from capital flows as well as from FI flows because of softening dollar index and elevated US interest. And India will exceptionally benefit because of collateral advantage. See, the first scenario for India, it's a collateral damage. In the second scenario, it will be a huge collateral advantage because of largely domestic-driven economy with least exposure to exports and a huge diversification in supply chain which will get unleashed because of this new tariff regime. So which side of the camp we are in? So that way I think you need to look at this through probability kind of prism. In that perspective, I think the probability for the first scenario is very, very low, though one can't rule it out. But going by what's happening in the last few days in terms of de-escalation between China and US in terms of tariffs, as most of you must have noticed, last night China exempted some of the imports from tariff from US. So there is a level of sense of de-escalation in terms of tariff war between China and US. Going by all this and the check and balance which the bond markets hold on the Mad King, it looks like that the probability for the second scenario is very, very high. So already the markets are more or less, the Indian markets are more or less penciling in that kind of a scenario. That's why the FIs have started coming back. And also India was one of the first large market to cover the entire losses from this Liberation Day. Even now, if you look at US is down by 3%, and most of the, Hang Seng is down by 5%, and excluding the fall of yesterday, and going by Thursday's level, India is still up by about 3-4%, whereas most of the markets are still down. So that tells you that the market participants are penciling in a sweet spots kind of a scenario for India, right? So these are the two camps. So does it mean Indian markets will go back to its momentum days of 2024 and 2023? In our view, it's very unlikely. Of course, this is a very favorable scenario, which is second one, which if it plays out, it will be great for Indian markets. A lot of capital flows, both on FIs as well as FDI will flow, and there will be a lot more manufacturing activity in India. All that scenario is good. But in the next, if you look at for the next 1 to 2 years, the earnings growth and also the GDP growth is likely to be subdued. It's very unlikely to be, giving you the kind of earnings growth which we saw in 22 or 23. It will still be a low double digit at best, which means the markets will find it difficult to get back to the momentum of 23 and 24. So what is likely to happen is more of a sideways kind of a market with upward bias, which will probably favor a lot more stock pickers, bottom-up stock picking, and selective sectors which, find favorable tailwinds. And that's the way we are looking at this market. So more or less the value strategy also likely to perform better in this kind of a scenario. With this, overall, I conclude my opening commentary. Thanks a lot once again for joining on a weekend and good participation and a lot of questions. I hope we could clarify most of the questions you had and clarify that convincingly. And look forward to the next one, probably in October this year. By the time we'll have a lot more clarity in terms of how the whole liquidation is progressing. Thanks a lot once again. Thank you. Thank you very much.
Thank you. On behalf of Trustline Advisors LLP, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.
For more videos, subscribe to our YouTube channel for our regular updates and follow us on other social medias.